Hello everyone, and welcome back to another episode of Our Abundant Life, where we share with you our thoughts and ideas and tips on how to increase your wealth and things like that. In our last video, hopefully you've seen it, we talked about how we're taking steps towards investing in the property market, and today's video is going to be something a little bit different.
Right, so today's video we're going to be talking about investing in the stock market and more importantly in index funds, which is where we're going to be investing our money this year. We have previously invested in the stock market and we did pretty well. We took a course a while back and we learned just the basics of the stock market, and we actually made a decent amount of money. We sold our stocks and we used that money to go to Disneyland. We took our kids to Disneyland, and at the moment we're just starting to prepare for our trip to the States again in September, and we're trying to weigh out whether actually we want to go back to Disneyland again because it is so expensive.
Very expensive.
It's like gone up dramatically. I think it's like $2,000 for our family of six. There's six of us now to go to Disneyland for 2 days. It's like $1,000 per day at a part, not including all your food. So yeah, weighing out whether we want to do that again or not.
Right, so first of all, let's talk a little bit about what stocks are. Stocks or shares are basically part ownership within a company. So companies will sometimes need money to be able to improve their situation, to maybe expand or something else like that. So they'll sell off a portion of their company, and this is called the stock or the share. So their share, say for example, they might be selling off 20% of their company, making it available for people in the public to invest in. So they might divide up that 20% of their company, and you as a person in the community or the public will be able to buy a portion of that 20%, and that becomes your share within the company. So as the company increases in worth, your stock or your part within that company also increases in value. And also, as you are a part owner of the company now, you're entitled to receive part of the profits that they make.
Yeah. So for example, if you buy shares in Netflix, for example, you're now a part owner of Netflix. And if only Netflix sounds great to you, you can do that for $350. That's the cost of one share in Netflix. And a little fact about Netflix: if you had invested $1,000 in Netflix 10 years ago, that share, that $1,000 would be worth close to $50,000 now 10 years later, which is great. But if Netflix isn't your streaming of choice and you are more of a Disney fan, you can buy a share in Disney for less than half that price of Netflix for only $130 per share. Alright, so let's talk index funds. Index funds are probably like the best invention when it comes to the stock market. Index funds are like a collection of stocks all put together. So instead of investing in individual stocks, you can invest in like a bundle, like a combo of stocks, for example. In Australia, one of the most tracked and followed index funds is called the ASX 200, which is a collection of Australia's 200 top companies. In America, in the United States, they have a similar index fund which is called the S&P 500, which tracks the top 500 companies in the United States. One of the best things about this is that it diversifies your investment. So instead of putting all your eggs into one basket, for example, you are putting them into lots and lots of different baskets. So if one company goes down and their worth is not as great anymore, then you have, 199 more to back you up. So it makes it a lot safer because you're not putting everything into one place.
So why should you invest in an index fund? The reason why we're chosen to go in this direction is because index funds perform consistently and often do better than self-managed funds. A self-managed fund is where you individually go out and pick which companies or stocks that you want to buy and invest in. And regularly, just the top 200 companies, investing in an index fund that covers those, so for example for Australia, the ASX 200, will do better than just your own ideas and your own investing in different companies.
Yeah. Alright, so I'm going to tell you a story about probably the world's greatest investor, Warren Buffett. If you don't know who he is, you should probably go and do some Googling and find out who he was. Back in 2007, Warren Buffett made a bet that a bundle of self-managed funds would be worse off than the S&P 500 after 10 years' time. Only one person took him up on his bet. His name was Ted Sneides. I think that's how you say his name. And They both invested $50,000. Ted Sneides invested $50,000 in his own picks, in the stocks that he picked himself, and Warren Buffett invested in the S&P 500. And then on the 31st of December 2017, they came and they got their things out and they decided who was the winner.
Check their results.
And Mr Sneides made an impressive amount. He increased his $50,000 by $220,000, which is nothing to laugh about. Anybody would be happy to have that amount of money. However, Mr Warren Buffett increased his money by a cool $854,000, like almost $1 million he increased, just investing into an index fund, a very low cost index fund. It's not expensive at all to invest in the S&P 500. Just your initial investment is only $3,000. That's all you need to be able to invest in the S&P 500, and you don't have to go and look up all the things
and do all that hard work to find out which ones you think are going to do the best.
Yeah.
So, who should invest in index funds? The short answer is anyone and everybody. Yeah. You might be just like me and have thought in the past, like I did when I was younger, thinking that investing in the stock market or in the share market is only for the really rich people to do. But with some research that we've done, we've realized that you can invest in the stock market or in share market for very low cost. Yeah. As low as like $100 or even less than that.
Even less than that, depending on what you want to buy.
But yeah, investing in index funds is definitely a great option because it's so low cost and it's also very passive. You don't have to do a lot of the hard work. If
you were going to pick your own stocks and things like that, you would want to research pretty hard, and nobody really has time to go and read annual reports and forecasts and things like that. It's just, I don't have time for that. I don't know who really does have time for that, to be honest. But with index fund, you can just be guaranteed that you're buying into a decent amount of quality stocks that perform consistently. You're not trying to beat the market. You're not trying to make a lot of money quickly. You're just trying to follow the trend, which is, playing it safe. I like safe. I don't want to invest too much risky investments. Unlike real estate, where you need tens of thousands of dollars to get started and get a down payment, investing in stocks you don't need that much money. If you're going to invest in an index fund, depending on where you live, in Australia it's about $5,000 to invest in an index fund. I know in the United States you can get started at like $3,000. I'm not sure if that's just the exchange rate work in play there, but I don't know. But that's a lot cheaper than like $50,000 for a down payment on a house, and you can start building your wealth slowly and slowly and slowly, and eventually in the long term it's going to pay off, because it's not a get rich quick scheme. You're not going to be like a millionaire in 12 months time. It's like over time, okay? And once you've invested that initial amount of $3,000 or $5,000, you can just set up like a recurring payment, maybe $50 a week that you're going to just keep adding into your investment, and it will just keep going up and up and up. At the end of each year or quarter, depending on what you've invested in, they'll pay you dividends, which are the money that you've earned from having your money with them. A lot of the time you can just reinvest those dividends so that it just accumulates and accumulates, or you can take that out and you can just have that for extra spending money, or depending on how old you are. I mean, a lot of elderly people, like the old people who've invested in stocks a long time ago, they just live off the dividends. They keep all their money invested, and then at the end of each year when they get paid out, that's the money that they live on, because they've had their stocks invested for, 30 years. So they're earning a heck of a lot of money now, especially if they invested in Netflix.
And that brings us to another one of the benefits of investing in stocks or in shares. Is that it's quite available to you. So you can sell off the stocks or the shares that you own and get the money for that in the next 2 or 3 business days, depending on where it is and what it is. Whereas selling off a house, if you've invested in the property market, it can take months, years, or who knows how long it could take.
And very, very stressful as well.
Yeah, and there's a bit more effort and work in selling a house.
Yeah. But when should you invest? Usually I would tell you to invest as soon as you can, but at the moment the share market and the stock market has been riding like the highway for a long time. The stock market goes in like waves, okay? So there's the low season and then there's the high season, and it usually goes on a rotation of every 6 years. But at the moment, this high wave has been going for almost 10 years. The last stock market crash was in 2008, 2009. So we are long overdue for a stock market crash, which a lot of the investors and economists are predicting is going to be in the next year or two. So what we're doing is we are saving like crazy so that when the stock market crashes, we can buy up all the stocks. Because what happens when the stock market crashes, the price of stocks goes right down, and everybody is going crazy, selling all their stocks because they don't want to lose their money. But that is the best time to invest because all the stocks are at a super low cost. And history tells us that the stock market always recovers. It's never going to stay down low. And when it recovers better to a better position than it was when it first crashed. So
yeah, at the end of the day, index funds are definitely a great way to go, and that's why we've chosen to head in that direction for all those reasons. They're low cost, doesn't take a lot of money to get into, they are consistent in the way that they perform, they're reliable. Yeah, we like safe and reliable. Definitely.
It's not a get rich quick scheme. Like, you're not going to make a lot of money overnight or within a year. A lot of stocks you can buy and you might make a lot of money in a year, but it's very risky. You don't know exactly how it will perform. But with index funds, you're pretty much guaranteed that they're going to perform over the long term. It's like a 10, 15, 20 year investment that you're wanting to do.
Yeah, definitely. So yeah, those are some of the reasons why we're going to go with index fund when it's time for us to invest in the stock market. When
it crashes down. So get saving, and so when it crashes that you'll have some money to set aside to invest in the stock market. If you found this video informative or useful, make sure you like and comment and subscribe. If you have any ideas, back to like the beginning when we're going to the States, if you have any ideas of where we should go or what we should eat, we would very much appreciate them.
We've already got a lot of places planned out, and when I say we, I mean...
He just likes to come along for the ride.
And for the food.
Yeah, but if you have any ideas, put them down below, because I'm always open to like different places and different things to eat and do.
Thanks. Have a great week.